Imagine paying zero tax on every dollar of growth, every dividend, and every dollar you eventually withdraw, for the rest of your life. That is not a loophole. That is the tax-free savings account, and the Canadian government built it specifically for you to use. The staggering reality is that the majority of Canadians who have a TFSA are either holding cash inside it, not contributing the full amount they are eligible for, or have never opened one at all. Today we fix that. The name is genuinely misleading. The word savings makes most people think of a low-interest account at their bank. But the TFSA is actually a registered account wrapper, meaning it is a container that can hold cash, guaranteed investment certificates, exchange-traded funds, stocks, bonds, and more. Any growth that happens inside the container is completely invisible to the Canada Revenue Agency. You own nothing on the way in, nothing while it grows, and nothing on the way out. Every Canadian resident who is 18 years of age or older accumulates contribution room each calendar year, whether or not they ever open an account. If you have never contributed a single dollar, all of that room has been quietly stacking up since the TFSA launched in 2009. The critical thing to understand is that room is not lost when you withdraw, it comes back to you on January 1st of the following year. That makes the TFSA far more flexible than most people realize. Before you contribute a single dollar, you need to know exactly how much room you have. The single most reliable source for this number is your CRA My Account portal online. Your financial institution may show you an estimate, but only the CRA holds the official figure. Overcontributing to a TFSA triggers a penalty of 1% per month on the excess amount, a completely avoidable cost that catches thousands of Canadians every year. Log in, confirm your number, then move forward. The overcontribution penalty is one of the most common and most painful TFSA mistakes. It typically happens when someone withdraws money in one year and recontributes that same amount before January 1st of the following year, not realizing the room has not yet been restored. It also catches people who hold multiple TFSAs at different institutions and lose track of their total contributions. The rule is straightforward: track every dollar in and every dollar out, and when in doubt, check the CRA first. Because the tax shelter inside a TFSA is most powerful when the growth is largest, holding simple cash earning a minimal rate of return is arguably the lowest value use of the account. The accounts that benefit most from the TFSA wrapper are those holding assets with higher expected long-term returns, diversified equity funds, dividend-paying stocks, or broadly diversified exchange-traded funds that track the Canadian or global market. The logic is simple: the more the account grows, the more the government would have taxed that growth in a regular account, and the more you save by keeping it inside the TFSA. A common question is whether to prioritize the TFSA or the Registered Retirement Savings Plan. For most Canadians, particularly those earlier in their careers or in lower income brackets, the TFSA deserves priority. RRSP contributions reduce your taxable income now but create a tax bill on withdrawal. The TFSA asks nothing on either end. If your income is lower today than you expect it to be at retirement, the TFSA is almost always the more efficient vehicle. The two accounts are not competitors, they are complements, but sequence matters. The single most reliable way to max out a TFSA is not discipline, it is automation. Setting up a pre-authorized contribution that moves money into your TFSA on the same day each pay period removes the decision entirely. You never see the money in your checking account, so you never spend it. Pair that with a simple, low-cost investment like a diversified ETF on automatic purchase, and you have built a system that compounds quietly in the background every single month, regardless of what the market is doing. The reason financial analysts consistently call the TFSA one of the most powerful tools in Canadian personal finance comes down to one concept: compounding free of tax drag. In a regular taxable account, you owe tax on dividends each year and capital gains when you sell, which erodes the base that compounds forward. Inside the TFSA, every dollar of growth stays fully invested and continues to compound. Over decades, this difference in the compounding base becomes the difference between a meaningful retirement cushion and a transformational one. The first mistake is treating the TFSA as a place to park cash rather than invest it. The second is withdrawing and recontributing in the same calendar year without understanding the room rules. The third, and perhaps most costly over time, is opening the account but never selecting an investment, leaving it sitting in a default low-interest holding position that many institutions set as the starting point. Each of these is fixable, but the fix requires awareness. If any of these describes your current setup, the time to correct it is now. High-income earners benefit from the TFSA, But they also have access to complex tax strategies that lower their exposure in other ways. It is middle-income Canadians, those building wealth steadily over a working career, who stand to gain the most proportionally. A fully maximized TFSA built over decades can meaningfully supplement a retirement income, reduce dependence on government programs, and provide a pool of savings that can be drawn on at any time for any reason without triggering clawbacks on benefits like old age security. The TFSA is not complicated. It rewards consistency far more than it rewards sophistication. Open the account if you have not already. Check your contribution room at the CRA. Choose a simple, low-cost investment that matches your time horizon. Automate your contributions. And then let time do the work. The Canadians who finish ahead are not the ones who timed the market perfectly, they are the ones who stayed in the account, kept contributing, and let compounding run undisturbed inside a tax-free container. As the Bank of Canada and housing market continue to create uncertainty, this is one variable entirely within your control. Watch for the annual contribution limit announcement each fall. That is your cue to update your plan for the year ahead. If this kind of analysis is useful to you, subscribing keeps it coming.